Right now, somewhere in your city, there is a man driving a 5-year-old Camry, buying groceries at Aldi, wearing a watch that cost less than your phone case, and he has $800,000 sitting in accounts you will never hear him mention. And somewhere else in that same city, there is another man. He just posted his business class seat on Instagram. He talks about his investments at every dinner. He bought a house in a neighborhood that required him to stretch his credit to the absolute limit, and he is one missed paycheck away from a conversation he does not want to have with his bank. The difference between those two men is not income, it is not intelligence, it is not luck, timing, or a rich uncle. The difference is something the financial industry has spent decades trying to make you ignore, because the moment you understand it, you stop being profitable to them. The loudest people you know about money are almost never the richest people you know, and I do not mean that as a personality observation. I mean it as a financial law with measurable consequences, with a specific mechanism, and with a documented dollar cost that compounds against you every single month you get it wrong. That is what this video is about. Not hustle, not motivation, the actual mechanics of how noise kills wealth and silence builds it, and the specific strategy you can deploy to exploit the gap that almost nobody in your circle is paying attention to. Let me start with something that should rewrite the way you see money entirely. There is a psychological phenomenon studied extensively by behavioral economists at the University of Chicago called the visibility-spending correlation. The finding is this: the more visible your financial position is to the people around you, the more your spending adjusts upward. Not because of greed, not because of pressure from others, but because your brain begins protecting the image it has projected. You stop spending based on what makes financial sense. You start spending based on what is consistent with the version of yourself that other people now expect. Your money stops serving your future. It starts serving your reputation. That is not a soft concept. That has a hard dollar cost, and I am going to show you exactly what that number is. But first, I need you to understand why the loudest person in the room is always paying the highest invisible tax in the room, and why that tax never shows up on any invoice. Think about the last person you know who made a significant financial announcement: a raise, a business win, a new investment. Maybe they bought something visible, a car, a house, a watch. Now, watch what happened in the weeks and months after that announcement. The social expectations around that person quietly shifted. The dinners got slightly more expensive. The trips got slightly more ambitious. The asks, some direct, most indirect, started calibrating to the new number people had assigned to them. And here's the part that costs the most. They started calibrating to it too. Because once you broadcast a financial identity, your subconscious spends energy maintaining it. Every decision gets filtered through a new question your brain is asking without your permission. Does this match who I said I am? That filter is expensive. There is a woman I'll call Adaize. She spent 8 years in corporate finance in Lagos, built her skills, moved to London, and by 32 she was earning £95,000 a year as a senior analyst. She was the first person in her family to reach that income level, and she was genuinely proud of it, which is not a flaw. That is a human being responding normally to hard-earned success. The problem was what she did with the pride. She shared it. Not recklessly, not arrogantly, she just stopped hiding it. She wore the success, the apartment in Zone 2, the holidays, the car she had been waiting years to justify. She told her mother, she told her siblings, she let the office culture read her income through the restaurants she chose for team lunches. By 35, Adaize had 3 years of strong earnings behind her and less than £12,000 in savings. Where did it go? Not to bad investments, not to reckless spending on herself. It went to the cost of being Adaize,
the version of Adaise that existed in other people's minds. Her sister needed help with school fees. Of course, Adaise handles it. She's the one doing well. Her mother needed a flight. Adaise books it, because who else would? The group holiday was priced above what two members of the friend group could comfortably afford, but Adaise could afford it, so the trip happened, and Adaise carried the invisible surcharge of being the person who can absorb it. She did not resent any individual decision, but the cumulative math was destroying her. Here's the reframe that changes everything. Adaise was not being generous. She was paying a tax, a visibility tax, and the rate on that tax was set not by her income, but by the gap between what she had announced about herself and what she was willing to let people see her refuse.
Every time she had the chance to say, "That doesn't work for me financially right now," the image she had publicly built made that sentence cost more than the bill she paid instead. She was not trapped by her income. She was trapped by her reputation. Now, let me show you the number that should make this impossible to dismiss. Take someone at 33, with £180,000 invested, a genuinely solid position, built on discipline and sacrifice. If the visibility tax on that person runs at just £350 per month, and in a professional social environment in any major city, £350 is conservative. This includes the round you picked up, the upgrade you didn't argue about, the family situation you absorbed because it was easier than the conversation. If it runs at £350 per month, and those £350 had instead been invested at a 7% average annual return, over 25 years, that is £290,000 in compounding that never happened. Not from a bad trade, not from a market crash, from being visible. At £600 a month, which is not unrealistic in London or Lagos or New York, the number exceeds £500,000 over the same period. The visibility tax does not show up on your bank statement. It shows up in your net worth at 55, when you look at the numbers and cannot understand why someone with your income and your discipline ended up with this outcome instead of the one the math should have delivered. Let me show you the other side of that equation, because this is where it gets genuinely useful. There is a man I'll call Tunde. He works in the same industry as Adaise, earns less, lives in Zone 4, drives a Volkswagen Golf that he bought in cash 2 years after the model year, which means he paid roughly 60% of what it cost new. His colleagues have no firm read on his financial position. His family knows he is responsible. Nobody has a number. When his friend group books trips, he sometimes joins and sometimes doesn't, and both feel equally natural because he has never established a baseline that requires explanation when he deviates from it. His social contract is Tunde is solid, not Tunde is wealthy. Solid. At 38, Tunde has £310,000 in invested assets, no inheritance, no windfall, just the compounding of the gap between what he earns and what his visibility requires him to spend. That gap is wider than almost anyone in his circle would guess, because almost anyone in his circle has no real data on him. His financial acoustic signature, as engineers in his industry would call it, is nearly zero. Here is what £310,000 at 38 actually buys you. And this is the insight that the financial media will almost never say out loud, because it is not a product you can sell. It buys optionality, the freedom to make a choice that would be impossible if your spending floor was set by your reputation instead of your values. Tunde can take a 40% pay cut to move into a role he actually finds meaningful, and the math still works. He could absorb a 6-month income gap without catastrophe. He can say no to a client he does not want to work with. He can wait for the right deal instead of the available deal. He can negotiate from a position of patience rather than necessity. That is what wealth actually is. Not the car, not the apartment, the patience. And you can only have the patience if nobody has stolen it from you by making your spending non-negotiable through the image you broadcast. There is something I want you to understand about why the loudest financial voices in your life are usually the most financially fragile. It is not a coincidence. It is a mechanism.
When someone is genuinely secure, they have no incentive to perform security. The performance is a symptom of the absence of the thing being performed. This is also true in professional environments. The person who opens every meeting by talking about their deal flow, their portfolio, their next move, they are renting credibility they do not own. Because the person who actually has the position does not need to make you aware of it. Their leverage operates in silence. Their options are real precisely because they are invisible. You cannot squeeze a person you cannot locate financially. If this is shifting the way you think about money, subscribe. The algorithm will not surface content that challenges the standard financial narrative unless viewers actively push it. This is the one moment I ask. Now, let me give you the tactical framework, because understanding the problem without the strategy is just expensive anxiety. The first move is what I call a financial noise audit, not a spending audit, a noise audit. For the past 12 months, trace every signal you have sent about your financial position. What have you posted, said, implied, or allowed people to observe? What number would a perceptive person in your closest circle assign to you if they were asked? If the answer is reasonably accurate, you're running a high acoustic signature. The work begins immediately. Stop adding data points. Make no new announcements, no visible upgrades that recalibrate expectations. You cannot erase what has already been seen, but you can stop sharpening the picture. Over 18 to 24 months, the signal fades. People update their mental model when it stops being refreshed.
The second move is decoupling your milestones from your social calendar. This is psychologically the hardest part because it runs against something that feels earned. When you cross a significant threshold, the first £100,000, the paid-off debt, the first income year above a number you once considered impossible, there is a human instinct to mark it, to let it be witnessed. I am not telling you not to feel that. I am telling you that the people in your life who are best positioned to celebrate it with you are almost certainly the same people who will, without any conscious intention, begin calibrating their expectations to it. The milestone is real. The compounding is real. The only thing that changes when you tell someone is the social contract that forms around that number. Write it down. Tell your partner if they are your true financial partner, then let it compound in private. The third move is building what I call an invisible reserve. Not your emergency fund, that can be known in abstract. This is a specific, separate layer of capital that exists entirely outside anyone else's awareness or expectation. A number only you know. A position that means you could absorb any social pressure, any unexpected obligation, any sudden opportunity without flinching, without negotiating, and without anyone in the room understanding why you are so calm. The person who can absorb anything never has to react to anything. Reaction is expensive. Composure compounds. Here is the deeper truth that most financial content refuses to say directly. The consumer economy is not a neutral system. It is an incentive machine, and the incentive it is optimizing for is your visibility. Every rewards program, every aspirational advertisement, every social media platform is engineered with one core function: to make you broadcast your consumption so that your aspirations can be monetized. The discomfort of financial silence, and it is real, it does feel slightly antisocial, slightly odd to not participate in the performance. That discomfort was constructed. It did not emerge from human nature. It was manufactured by systems that profit from your noise. Once you understand that, staying quiet stops feeling like discipline. It starts feeling like leverage. Let me take you back to Adeyeze, because her story has a second chapter. At 36, after a career shift that forced her to sit with her actual financial numbers for the first time without flinching, she made one decision that changed everything. She stopped updating people's picture of her. Not dramatically, not coldly. She just stopped providing new data. The flat in Zone 2 became a flat share in Zone 3 that she framed as a choice, not a retreat.
The visible consumption slowed, and she let the silence fill in without explanation. Within 14 months, the social expectations had quietly reset. The asks became less frequent. The group trip planning started accounting for a wider range of budgets again. And Adeaze, for the first time since her salary crossed 6 figures, started keeping more of what she earned than the image of herself required her to spend. At 40, she had £95,000 invested, starting from nearly zero at 36. In 4 years, on the same income, nothing changed except the noise level. The game is not about earning more. Almost everyone reading this already earns enough to build something significant. The game is about the gap between what you earn and what your visibility forces you to spend. That gap is the engine. Everything else is just noise around it. The wealthy do not stay wealthy because they earn differently. They stay wealthy because they operate differently, quietly, without announcing their position, without performing solvency for an audience that was never going to vote them richer anyway. They move through the financial system the way a ship moves through deep water, not against the current, below it, invisible to everything on the surface, building momentum that the surface will never fully see or understand. The middle class was taught that financial success is something you display, that the car, the postcode, the restaurant, the label, these are the proof that the strategy worked. But proof is expensive. Proof requires maintenance, and proof is always aimed at an audience that has no financial stake in your outcome. The wealthy were taught, or figured out, usually the hard way, that financial success is something you protect, that the most powerful position you can hold in any negotiation, any decision, any unexpected moment of pressure is the one where the other party does not know what you can absorb, where they cannot see your floor, where your options are real and your need is invisible. Quiet is not a personality type, it is a strategy, and in a world where every platform is optimized to extract your financial signal and monetize it back to you, running silent is not just a discipline, it's an edge. The next time you feel the pull to share a number, announce a milestone, post a win, let someone see the robe, pause, ask one question: who benefits from this information? If the answer is not a specific, concrete, financially meaningful benefit to you, then the answer is not you. Let it compound in the dark. That's where the real money lives.